Hello, everyone. This is Andrew Berman. Thank you for joining us for our Mortgage Banker Magazine webinar. So excited for you to join us today. Always actually like hanging out with my good buddies from Credit Expert with us today. We've got a special treat on what we normally have. So joining us today from Credit Expert, we've got Mike Darn and Dan Green. It's going to be moderated by the legendary Rick Grant. Gentlemen, I'm so excited for you guys to join us. And Rick, thank you for adding a little something actually onto what I was already excited about.
Well, thank you, Andrew. Let me just say, it's good to be working with you again. It's been too long.
Well, you know something. I mean, so Rick brings like this great cross section of of mortgage industry intelligence. As worked actually with a lot of the settlement service providers. But he gets credit. He understands technology in a way that so few do, and has always has had an uncanny ability to kind of break down what seems to be very complicated and make it easier for everyone to understand. Before we get started here, if you can, and we're going to go through a little bit about the presenters here, but do we have everyone take your phone and turn it actually to silence. If you have Outlook opened or Encompass, Calyx, whatever it is, shut it down. You know how we roll. We'll be out of here inside of an hour. So without further ado, gentlemen, tell us about actually what we're going to be experiencing today.
Well, that's a great introduction, Andrew. Again, it's great to be working with you. Part of the reason I've been successful in this industry is because I have found the smartest people, and I got to tell you, I'm with them today. You already know Andrew. If you don't know Mike Darn, Vice President of Marketing at Credit Expert, you're going to meet him today and find out what they've been doing with their data science experts over in that company. And Dan Green, he's been around the industry for a long time. He's a principal at Blackfin Group now, but you've known him from way back in his credit union days until today. Gentlemen, thank you both for being with us. I want to thank all of you in the audience for being with us today too. You're probably familiar from these webinars with how it works on the question and answer. Over on the right or somewhere on your screen, you're going to find a place where you can key your questions right into the screen. Even though we're going to hold those till the end, Andrew's going to help us walk through those at the end. Put them in there as soon as you think of them, because we want to make sure that this presentation gives you exactly what you hoped to get when you came here. Now, with a name like 3 Ways to Use Credit to Win in a Competitive Marketplace, I got a pretty good idea. I know why you're here. You want to find out how you're going to grow in a market that makes it look like that's impossible. So Mike, tell us about what we're going to be talking about today.
Yeah, so thanks for that intro, Rick. Super excited to share what we have here with everybody on the call. So really, we're going to look at 3 things here today. So, no surprise to anyone, we are in a choppy market. So, we're looking at increased competition. We're going to share a little bit around like what we're seeing, but also what we're hearing from lenders. So we've done some recent survey work there, looking at interest rates as they're going up, projected mortgage originations, specifically around that refi market. 2022 is going to be a year of ups and downs, we believe. But there's actually some data that we're going to share with you all. We launched it last week. Super excited about this, but we'll get into it a lot more. But we're seeing opportunity out there, right? So what we do at Credit Expert is we're able to understand potential in people's credit scores. And a number to keep in mind, and you're going to see this a few times today, is the 71% number. So what we know is that 71% of those that are below 760 when they originally come in could better that score by at least 20 points within a 30-day time frame. And then we're also going to talk about how you can roll up your sleeves and apply what you're seeing in the market, what we're showing you in the data, to build out a credit strategy that can help you grow production profit, in what may look to be, a down or certainly a very different market than what we've seen over the past couple of years. So that's a quick overview of what we're going to be covering today. And I think we're going to start things off with a quick poll question. So Andrew, would you be able to throw that up?
Sure. All right. So we want to actually get a gauge for the audience and see what kind of credit are you seeing. So you'll see on your screen what credit score bands do your applicants typically fall. So please let us know here when you're looking at actually the clients that you're dealing with. Just please let us know. I'm going to keep this open till about 55%. We've already got 44%. So keep those votes coming in. And we're at 50%, 51%. We're going to keep it open for another 5, 4, 3, 2, 1. All right. So now, just out of curiosity, gentlemen, you guys deal with a lot of credit files. Do you have an idea of where you think we're going to be at?
We do, but we're not telling.
That's not fair. All right. All
I
right.
know, Andrew, it's not fair.
All right, so I'm going to share the results here. And there we go. So the winning by a significant margin, 48% say we're dealing with 680 to 739. So was that what you guys were thinking?
You know, and I'd say yes, maybe just a little lower, but compared to last year, a little lower. But this is right where you would expect kind of a purchase market to be. So yeah, this is what I think, Mike and Rick, this is exactly what we were expecting.
I think so. And the good news is we're going to be able to show everybody here on the call today really what the market's doing and where those scores are coming in. So we will give you some insight into what's happening in a much broader in the broader sense.
Good, but before we get into that, Mike, tell them a little bit about where Credit Expert is coming from and how you're coming by all this information.
Yeah, so not going to go deep into what we do at Credit Expert, but I think it's useful to just give a sense of what we do as to why we have a place and why we have a seat at the table here. So what we have is we've got a predictive analytics platform, and since our founding, we've analyzed nearly 1 billion inquiries. And just in a nutshell, how it works is for lenders that work with us, when they pull credit, they can look right on the PDF credit report. They can see by bureau the improvement potential. And so what we've done is we've gone and we've calculated those scores instantaneously to show the upside potential, or if there is no potential there. We then generate very detailed plans to show that applicant and the lender exactly what they need to do to reach a target score, and then allow the applicant to go follow that plan, resubmit, and come out on the other side with a better score. So I think the key here is that we've spent a lot of time here. We've analyzed lots and lots of records when we're highly accurate. And so what you're going to see is kind of the fruits of that, and how that turns up in what we're going to show you this afternoon. So Dan, do you have anything to add there?
Just something quick to reinforce is Mike said, this shows up on pretty much, I won't say all PDF credit reports, but it's readily available, hiding in bright sunlight, I would say. So you have access to this, and it starts to show you, and we'll go deeper into this. It starts to show you the potential that 71% of those borrowers below 740 have, which is big. I mean, it's huge.
Yeah, well, let's talk about that potential, because this is what you do for individual originators, right, Mike? But you found a way to go beyond that and help the entire industry. Talk to us about that.
Yeah, so I'm actually really excited to say that today is my 1-year anniversary being at Credit Expert. And so early on, I was looking at some spreadsheets and was looking at the potential that applicants had as they came in the door, or what their score was when they came in the door and what that potential could be. And I initially thought that was going to show that there was a lot of potential down in the lower bands, and there really wasn't much room for improvement in that mid to higher category. But what I found was that when I was looking at, last year's data, is that that was not the case. It was really uniform across all bands, whether you were up in the 700s or mid 600s or down low. On average, 71% of all of those below 760 could improve their score by at least one 20-point band within a 30-day period of time. And so I think that's important to note here as well. This is not a long-term engagement type of thing. This is a quick turn, and I think this is really important also in a purchase market, opportunity for applicants and lenders. Do you have anything to add there, Dan?
Yeah, just two things quick. I mean, as Mike said, this applies to almost every borrower. And if you go across the credit spectrum, keep this in mind. 2/3 of all borrowers, all mortgage applicants, could improve their scores. 2/3, big number. So I think, seriously important from that perspective. It's not just on the margins; it's everybody.
Yeah.
And I think the other thing that's super important, as Mike said, is this is something that can be done within 30 days while other things in the mortgage process are going on. It doesn't increase the mortgage origination cycle by 30 days. These happen concurrently. And you think about originating a loan, there's very few things you can do to help a borrower improve their position when they apply. Credit is like the one thing. So you can help potentially 2/3 of applicants within 30 days while their mortgage is going on. That's significant.
Exactly. And so I think, as I was, little over a year ago, or a little under a year ago, I was staring at these numbers and I was thinking, how can we put this to good use, right? So we're seeing a significant percentage of all of the inquiries as they come in, right, in real time. How can we put that out there such that we can help lenders think about strategies? And so I look to kind of frame it among, first, our mission, right? So our mission as a company is to make homeownership more accessible and affordable for all, right? And so there seems like there's some opportunity there, but I also wanted to kind of get it into a place where we are tagging it to something that is actionable for lenders, right? So, if you think about breaking it down, how can we provide insights to lenders around the opportunity that's there for them to expand access to homeownership, something that I know that the industry is really rightfully so focused on, in this year. How can it be used, certainly in a market like we're in, where home prices are going up, bidding wars are happening? How can lenders give their clients increased buying power? And then again, this is a very competitive market that we're heading into. How can we help lenders be more competitive when they're putting those offers out there? So anyways, I'd love to share with you all, with this wind up, kind of what we're doing here. And so what we decided to do with all of that is to say, look, we're going to put this data out there on a monthly basis. We put our first one out. We're in the process right now of getting the February numbers in. March numbers will be coming, but our plan is to launch these on a monthly basis, such that it is real-time data that lenders can action on. So I wanted to give you guys a sense of what's in this index, and we're going to show you in a more detailed way. So first of all, you're going to see two views here, right? You're going to see a macro, perhaps a more nerdy view of things, where we're showing you the overall inquiry volume as it's coming in across each of the bands, and I'll show you exactly what that looks like. We're going to show you the credit potential in each of those bands. You're going to be able to look at month over month and year over year changes to see how the industry is shifting in real time. And then, are there some leading indicators, right? So part of this is we want to put this data out there, and there are a lot more, there are a lot smarter people in the industry that we're hoping can take a look at this and uncover some things that maybe we're not even seeing here. So there's the macro view. And then we've got what we call the outcome view, and it's kind of similar to what I talked about, right? So what is the real impact, in these numbers that could be achieved? So expanding, access to homeownership, increasing purchasing power, and delivering more competitive rates. So before we get into kind of the spreadsheets and before I tell everybody to get out their reading glasses, because they're going to need them here in a minute, Dan, Rick, anything to add there on the overview?
Well, you know, the only thing I would add, and we're going to talk about this more later on in the program, is that this isn't just a competitive mandate that you find a way to find more borrowers and serve the borrowers you have better, but it's also really important to the current administration and the regulators. It's important that we make efforts to make housing more affordable everywhere we can. This is a great opportunity for that. Again, so I can't wait for you to see it.
Absolutely.
And the thing I would add to this from a macro view perspective is think about this as the demand side of mortgage credit, right? So we're all used to seeing, after the fact supply side numbers, weighted average credit scores of loans, right? Either in the aggregate or, if you're a real nerd, you can get the loan by loan data from HMDA or other places. That's the supply side. What we actually did. This is the demand side of what borrowers, applicants actually want. So pretty good, pretty important stuff. These are the people that are coming to you looking for a loan.
Yeah. And to that point, Dan, and just to emphasize this again, this data is going to be made available 4 weeks after the close of a month. So it's as real time as we're able to get it out there. It's not survey data. You're not waiting for the end of a year or a quarter or something like that. So let me go to, and again, I mentioned time to maybe get your reading glasses out here. I apologize for but what I'm going to try to do is just to take you through what you're going to see. Everybody on this call is going to get a copy of the Mortgage Credit Potential Index, and you can, slice and dice and take a look at this yourself, but I'm just going to walk you through. So this is one of the macro views that you're going to see. And as you can see, we've got score band from 360 down to 850 on the left-hand side. This is also a monthly view. So what you're going to be able to see is you can see on left to right, you're seeing what that volume looked like in December of 20. We're then going to show you what that volume looked like November of 21 and then of December 21. So if you go all the way over to the right-hand side, you are going to be able to see just from a volume perspective, what has happened year over year, and what has changed, on a month over month basis. And you can see here, there's some pretty significant changes, that you're seeing specifically on the year over year basis, right? So you're starting to see significant decline in volume in those upper bands, right? So that is probably an indicator that the refi market was in fact starting to dry up. You're seeing fewer of those. But then you're also starting to see some increases there in some of the lower bands. So maybe that's an indicator that you have more first-time home buyers or others looking to enter the market and feeling like this might be a good time. So anyways, that's a very quick rundown of what that might look like. Any additional analysis or thoughts there, Dan or Rick?
Well, and we're going to see this a couple of times, but on the far right-hand side, especially in the year-over-year column, this is why the first poll question came out the way it did, I believe, right? So you're seeing a shift to lower credit scores, which, as we said earlier, is typical of the prior shifts from refi to purchase. So the market's behaving so far, as expected. Kind of good to see, right? Something's predictable.
Yeah, we like certainty. We like certainty.
We do indeed.
So just to shift to another view. So what we're also going to be doing here, so that was a monthly view. So you're seeing the volume there. This is a rolling or trailing 12-month view. So you're going to be able to see, okay, in the 12 months prior to that period that we're reporting on, what was the total volume? What did that look like? And again, this is volume that is coming through our pipes, through our analytics engine. As Dan mentioned, we have a pretty significant market share, and we believe this is representative of the market as a whole. But again, you can start to see some of those changes, and I think, Dan, as you mentioned, right, you're starting to see some double-digit increases in those bands that are more typical of a purchase market, and some double-digit decreases on the upper end of the spectrum as well.
Exactly.
Cool. So what I just showed you is really kind of volume oriented, but what I think is really exciting, and it gets back to kind of what inspired us to think about launching this index, was the potential view. So what you're seeing here is 2 years, full year 2020, full year 2021. You're seeing the volume, as you did in the prior slide, of inquiries. And by the way, these are mid-score inquiries. These aren't individual bureau inquiries, but they're mid-scores that we're looking at. You're seeing where they came in initially. So for example, in the 740 to 759 range, you saw that there was just over 2 million inquiries that came in on that range. You're also going to see how that changes year over year. But then the next column over, the number up is the number of those. So 1.5 million of that 2 million could increase by 20 points or more within a 30-day period of time. And that represents 74% of that population. So this is giving you some insights into how much opportunity is there, where you might want to go fishing, right, if you will, and how a lender might want to rethink maybe their strategy in terms of looking at opportunity there. And so specifically, you know, we're looking at things like these are the bands here that a lender may want to focus on in terms of the opportunity that's available to those that may have previously been shut out of the housing, market, not being able to qualify. This is the band where you can move up, where you've qualified for a conventional loan, but as you can see here, with each of those three bands, you've got 73, 72, and 69% within those bands could get to the place where they could qualify for a jumbo loan, giving them more purchasing power, right? So again, these are not like nickels that we're tripping over here. These are significant populations that could move to, the next band. And then, also when you look at, being able to give the most competitive rates, you want to be looking at this band as well, or these bands. But I think more importantly, as we talk to lenders, all of this is relevant. So there's a big movement, and I'm sure many on the call are seeing this, towards transparency and really starting to understand credit. And we talk to a number of lenders that use what we do as a way to build that create that transparency and build the trust with applicants by basically laying the cards on the table and saying, look, we've run your credit, it came in at this, either there's opportunity to better that score, or you're great, and within the next 30 days, you're right where you should be, and therefore you've kind of established that credibility on the offer that you're going to be able to give them. So before we go into the next poll question and dig in a little bit more here, Rick, Dan, anything that I missed here in terms of this view? And again, everybody will be getting a copy of this so that you can, dig into it a little bit more and not have to squint as you're looking at these small numbers on the screen.
Rick, I'll defer to you, and then I do have a comment.
All right, well, the only thing I'm going to say is I'm excited about this poll question, because this slide here about increasing transparency and building trust, it really hinges on the fact that borrowers may think they know what their credit is, but they may not know. But the question, of course, is, do they actually know at all? And building that trust in a purchase money market is critical. We know that these borrowers or these applicants are making mortgage applications with a number of lenders. They're going to choose the one that they trust, and the one they trust is going to be the one they think is telling them the truth. So this is so important in this market.
It truly is. I mean, and this is a very great way to start that conversation, and start that conversation really at the first opportunity that you have, because as Rick says, we know that more than half of borrowers will apply with up to 3 lenders. So you're in the running, but you don't have a closed loan, nowhere close actually. I think the other thing is, as we said, this doesn't apply to just a few lenders or few applicants on the margin. This is the vast majority of applicants who can be helped. in one of the important 3 ways Mike pointed out. Increased access to housing, increased access to larger loans for those who are interested in jumbos, and improved rates for most. There's nothing else you can do for a borrower in the near term or an applicant in the near term that has this big an impact. And with rates rising, this is also the way you keep affordability possible. One of the ways you keep affordability possible.
Yeah.
Because we're all concerned that rates are going to go up. Likely Fed announcement today,
Right.
we mean 1/4 of a point. But you can keep people in the housing market if you help them with, help them better their credit scores.
Yeah. Now, before we move on, Mark, real quickly, Mike, remind us again the columns here. The left is the score band. The first column is
The first column is the volume, right? So it's the number of mid-score inquiries that were done within that period of time. The next one over, the one with the number sign and the arrow, is the number of those that could improve by 20 points, at least 20 points to be clear there. And then the next one is the percentage of that initial inquiry volume that could improve by that 20 points.
Good. Very good. Okay.
So why don't we go to the poll question here, and then we're gonna show you actually what those numbers look like from a kind of action orientation perspective.
Okay, and this is the what in your experience contributes to pipeline fallout, right? As I see, we have two questions left. The other one is approximately what percentage of applicants are aware of their mortgage credit score?
So I think it's the second one that Rick wanted to have out there. Is that right?
Yeah, but we'll get to it. I mean, it's either way. But yeah, let's do that second one first, because I want to make sure they understand what an opportunity this is. Right?
So so it's the what is in your experience contributes the most pipeline fallout. Okay, so here we go. And I'm going to show this on the screen. So everyone, please, what in your experience contributes most to pipeline fallout? Let's get everyone to vote here. We're going to keep these open for a little bit. Already have just about 10% of the room has already voted. So keep those votes coming in and try to make it to 50% here. We already have 30% of the room has already voted. Keep those votes coming in. All right, we're gonna close this out. And by the way, if you still have questions, please, drop them in the question box. You will get all of your questions answered. We'll get to as many as we can answer here. And we've got 54% of the room has already voted. So I'm gonna close this out here. I'm gonna share the results. And there we go. So, gentlemen, hopefully you could see this up on the screen and see actually the results. The winner at 42%, applicant perception of price, rate, and loan options is the #1 that contributes to pipeline fallout. What do you guys feel about these results here?
I think it's what I expected. Again, Andrew, exactly what I would expect. And I think it also puts an exclamation point then on, hey, if you can help with access to different loan options, you can help with better rate, that'll cut that portion of fallout out. And as we all know, fallout's super expensive. So anything you can do to reduce fallout is a good thing, especially in a market that's not as big as it's been the last couple of years.
Yeah, I would guess to say actually, if people understood actually the work that can be done for credit optimization, the 31% would have been probably a lot higher, potentially being the a bigger opportunity.
I would think so too. I guess that, and that's I think what we're talking about today is let's try and make that a bigger number, right?
Yeah.
Yeah, well, I think you're exactly right, Andrew, because a lot of people are going to fall out. A lot of applicants are going to fall out before they even get into the pipeline because their credit is viewed as too low. And so if we add those in, the ones that have the potential to actually make it into the pipeline, that number is going to get a lot higher.
Absolutely. Cool. So I'm assuming you guys can see the next slide here. Correct? I'm having a little technical moment.
So you're good. So now you're going to actually tell us what we're talking about. What's the potential here for the originator?
Yeah, so as I had mentioned before, we've kind of got the nerdy kind of macro view of what's happening, and I just walked you guys through that. But there's also the kind of outcomes view, right? So if you take all of that data, and this is 2021, what we see as the real opportunity there is that of those that came in at 580 or below 580, 711,000 or 52% of those that came in initially could qualify for an FHA or an RHA mortgage within a 30-day time frame. So 711,000 people will have the opportunity, or could have the opportunity, based upon their credit, to become homeowners, and that's huge, and that's kind of what gets us up every morning at Credit Expert. Similarly, on the conventional, mortgage, those that came in below the threshold for a conventional mortgage, 1.37 million, or 43% of those could get to the point within 30 days that they could qualify for that. And then when you take a look at increasing purchase power, and I think there were some recent articles out there that mentioned that in 2021 that I think it was the largest number of jumbo origination since 2006, and that's in large part due to rising costs and home prices. Potential homeowners need that buying power when they go into an offer situation, and so nearly 2 million could go from a conventional to a jumbo. And then I think what's really interesting here is as you start to think about what makes a lender competitive, and we know that rate is big, and we're going to show you a little bit more detail there on some research that we've done, but 6.25 million applicants, or 68%, could move up a 20-point band, which would qualify them potentially for a lower rate. So again, throw it back over to Dan and Rick for additional comments that I may have missed here.
Well, I think the outcomes view, this outcomes view is super important, because it just puts an exclamation point on what we're talking about. These are real numbers, and I think more importantly, these are real people, right? Especially on the far left-hand side, where you're saying 711,000 people could have qualified that otherwise wouldn't, and that means home ownership for them or not, right?
Mm-hmm. Yeah.
That's significant. Not that the rest of these aren't significant, because if you look at the far left-hand side on better rate, it's affordability as well. So, super important and really large numbers is what we're talking about here, of people who can be helped. We just make that point over and over again.
Well, you guys actually put the pencil to paper, right? You figured this out for a hypothetical lender.
Yeah.
That's the next slide, I think, right? Show us that. That's pretty good.
So I think, Rick, it's a great point. We've been talking about, helping people here, which is at the end of the day what we're trying to do, but this is actually really good for lenders as well. So, we're working with a top 15 lender in this, and we were using HMDA data. And what we wanted to understand was the impact of optimizing credit. What could that have on a lender's bottom line? So we looked at things like what kind of fallout is happening pre-application due to credit, what kind of fallout is happening in the application process, and this is specifically related to credit, right? And we were pretty conservative here in terms of how we define that. And then also, as you all know, you make offers to applicants, and they've likely shopped around with another lender, and they'll go with them. And so, what could that fallout be there if you're able to offer the most competitive rate? And so, when we added that all up and we looked at what impact that would have on production profit, again, this is a larger lender, but $38 million in production profit could be saved here. And again, we were relatively conservative in terms of how we looked at this, but that's really meaningful, right? So if you think about what you might be able to do, whether you're a smaller lender or an individual, focusing on credit, what could that do for your bottom line? I think this really demonstrates that there's some meaningful upside for lenders, as well as we've been talking about, helping individuals obtain homeownership.
And what's really terrific about this analysis, and yes, Rick, Mike and I spend a lot of time playing with numbers, as you can probably tell. You know, when we're talking about, this is the pull through. I mean, when you're talking about what this slide is talking about, it's talking about pull through. And we're talking about increasing pull through, you know, a few percentage points, 5-7 percentage points. Not, you know, we're going to take your pull through from 60% to 90%. Yeah, maybe you could do that. But the point is here, you don't have to make a meaningful difference in profit, right? Small gains matter, and it shows in this slide very, very clearly. And I think, Mike, when we did this for this particular lender, they looked at it and went, yeah, that's pretty much the way our numbers work, right?
Yeah, you know, it's all fun to play with numbers behind the scenes, but we actually shared this with the FP&A team on at that lender, and they said, yeah, you guys are spot on in terms of what this could look like and what our fallout looks like here. So we felt really good about you know, what we produced here, and that's why we're sharing it with this team, and that it has been validated with the lender.
All right, guys, we got some good questions already coming in that Andrew's going to walk us through at the end. We've got about 20 minutes left, and I want to make sure that we take the time to really talk to the audience about why this is so important now in this particular market, right? And I know you both have been spending a lot of time studying it. I read the news every day. I see the signs on the wall, but not like you guys do. So let's talk about what lenders are going to be dealing with this year and why a tool like this is so important.
Yeah, and you can see here, I think officially this year is the year of the tiger. I've coined it the year of the roller coaster, right? And I think, you know, there's some real reasons for that. As I mentioned at the top of the hour here, you know, it's likely going to be a pretty choppy year. We're looking at some steady increases in, you know, rates, which is going to impact, you know, originations, and you're going to see much of that impact coming in the form of the drying up of the refi market. But then also you look at things like consumer sentiment, right? So things that we should be looking at right now. You know, we've got a lot going on in the world right now. And so you have to think about, even if interest rates hold, you know, are consumers going to feel like this is a great time to buy? So number of things that we're looking at there, but, you know, there's some serious potential upside here, right? So, you know, going to Zillow here and some of the trends that they're predicting, you know, they're expecting there to be about 6.35 million existing home sales, which is going to be the highest since 2006, right? We're still struggling though with a shortfall of new homes and likely of affordable homes. But then when you think about, and I think I mentioned this before, when you think about the refi boom going away, it may look a little bit different, right? You know, a lot of people bought homes over the past couple of years. A lot of those people compromised with those homes. They maybe bought a home that needed to be worked on, and a lot of equity has accrued, you know, over the past couple of years. And so there's a school of thought out there that people are going to start tapping that equity while they can, maybe doing some cash out refinances, maybe doing some home equity loans. So I think there's opportunity, and we just don't know what it's going to look like, you know, in the coming year. But I wanted to kind of point to some research that we did late last year with mortgage originators. And you can see, just to orient you around these graphs, we're looking at what we call small originators and large originators. Large originators are kind of in the top 20. And we asked them, you know, we said, hey, what are you most concerned about in 2022? And at the top of that list for both of them, well, actually, affordable housing really stuck out for some of the smaller lenders, but top of the list here was increased competition for applicants, right? We've spoken to a lot of lenders over the past year and a half at least, and they've had to really you know, triage and just go with, you know, applicants that they know are a sure thing, because there were so many inquiries coming in, that's not going to be the case. There's going to be a lot of competition for the smaller pool that's probably going to be coming in. Dan, Rick, you want to run down a few of these as well, things that originators are most concerned about?
Yeah, it makes perfect sense what they told us. I think that a lot of this is what we were expecting. I think, 2 slides ago, Mike talked about why the year will be roller coaster-ish and I think one of the things it does say, but it doesn't say is affordability will be an issue, right? Rates going up, not a lot. I mean, rates are still historically very low, but rate increases affect affordability. So does the price of housing, which is being affected by the limited supply, right? So, originators are, very right to be concerned about limited affordability. Again, though, if you can work on credit, that helps affordability, right? Helps offset rate increases. It helps offset the price of housing. Everything else here makes perfect sense. Rick?
Yeah, these are the typical concerns, but that affordability problem is going to be exacerbated by the fact that the current administration has really made this a key pillar of what it wants to get done. So lenders are under a lot of pressure to do something that they only have limited control over, right? So.
Right.
Absolutely. And just to put a point in, I think NHB released a study a week ago talking about the potential rate increase and what that might do to putting housing out of reach for a significant, population. So again, you go back to the index that we just shared with you, there are opportunities and there are tools to be able to, even in the face of a rising interest rate environment, be able to get potential home buyers to a place where they actually can afford it, to kind of counteract that rate increase there.
And I would say, I think another thing to add to that, there are tools available, like we've been discussing today, that help with affordability that aren't riskier types of loans, right? Not the type of thing we saw, pre-housing crisis. And those of us who lived through that saw the kinds of things that were done for affordability. That's not what we're talking about here. We're talking about things that make sense and keep the borrower and the lender safe.
Absolutely. Well, let's keep it rolling here. So another question we asked them, so we wanted to know, what are the opportunities that they're seeing? And, this is very intuitive, but it's clear, that we're shifting to a purchase market. So maybe those relationships with realtors and with builders have, maybe gone a bit stale over the past couple of years because of the refi market. But lenders are really looking at, okay, how do we crank those back up? How do we get those relationships going? How do we, in the face of a down market, how do we maintain or grow the share that we currently have? Always, a focus on profitability. So, a lot of strategic type of things that we're seeing here as the market's shifting. So let's move to, how we believe that lenders can use, credit to win in 2022. And this is where we've got some more specific recommendations. But I think if you were to sum it up for me, that when you look at that 71% number, right? And this is, again, 71% of all of those below 760 could improve by 20 points within a 30-day period of time. Or as Dan mentioned, if you apply it to everybody, that's still 2/3, like 63% there. When you see a number this big, you've really got to think about how you operationalize credit. It's not onesie twosie, I'm going to help, this particular applicant get over a particular hump. It needs to be operationalized across all spectrums. So anything to add there, Dan? I saw your white pen go up and I revealed your secret.
Yeah, it's the drum I beat constantly. This is the law of large numbers, right? 71% of a market that's going to be about 7 million loans is 5 million people, right? I mean, let's not talk about loans, let's talk about people. We say loans a lot, we mean people. 5 million people is a lot. And the ability to easily help 5 million people is something that can't be ignored and shouldn't be.
Yeah, absolutely. So let's go to another a poll question before we get into some of these details here. So Andrew, can you help us out with getting that up?
Right, I'm gonna launch the third and final poll here. All right, everyone, here we go. And on your screen, you should see a poll question. Approximately what percentage of applicants are aware of their mortgage credit score? Wondering actually the response is going to be here. So far we already have just about 20% of the room has already voted. Keep those votes coming in. We're going to try to hit 55%. We're already at 50%, so keep it
Well, and
open for another.
let me just kind of lead the attendees here.
Yeah.
We mortgage highlighted there for a reason. We're not talking about your Credit Karma score or a score that you're tracking through your bank, but the actual score that you're being evaluated on when applying for a mortgage.
All right, there we go. I don't think we're allowed to use the K word around here. So, all right, guys. So we're going to close the polls right now, and I'm going to share this up on our screen. And here we go. And there we go. There's our breakdown. So looks like the number one, actually, that 25 to 49% of applicants are aware of their mortgage credit score, not their fake synthetic consumer-friendly score. So, gentlemen, what are your thoughts about these results here?
Mike, why don't you kick us off?
Yeah. So, numbers that we've seen have been, on the much higher end, right?
Mm-hmm.
And it may have, I may have influenced the outcomes here, but we know that a lot of applicants come in the door empowered with their credit score, and it's the credit score that they've been tracking, and it's a different model than what, and this ends up being a really difficult conversation with a lot of lenders, because they have to kind of walk it back and say, I know you came in thinking you were 739, but really what we're looking at is like a 690 here, and here's the impact. So I guess this feels about right in terms of the specific mortgage credit score. But what are your thoughts, Dan?
I went right where you went. It's lower than, I guess, significantly lower than what we saw in the lender research that we recently completed. That said, this is what I would more likely expect, right? Because everybody knows their, the scores they see from their bank or their credit card, but that's not their mortgage score, and it's easy to confuse the two.
Correct. So I think there's an education opportunity here for lenders, but as we've got just a few more minutes here, let's keep it rolling so that we've got some time for questions here. So when we think about specifically, what we think lenders can be doing, again, going back to that 71% and the operationalizing credit, so make sure that potential is visible and actionable from the start, right? So we mentioned that today, lenders can see that potential if they're working with credit experts right there on the credit report. So going there first, understanding whether there's potential from the very beginning, time is on your side here, right? So the sooner you start working with an applicant, the better the outcomes. But then, as we think to the future, really getting that potential even farther up in the funnel, right? So, system integrations. Are you putting it there at the point of sale where people are coming in and inquiring, giving them not a, hey, sorry, you're going to be receiving, an adverse action letter, shortly in the mail, and kind of turning the no into a not right now, and here's the opportunity that you could, get to. Similarly, as we've been talking, this is not just about those that are falling out, but lenders should be working to make sure that they're getting their applicants in the absolute best place that they can, very early on in the process. Anything to add there, Dan? I know you've got some thoughts.
Well, agree with you completely, but I think it just says put this right up front, put this as close to the first conversation with the applicant as you possibly can. Keep them with you, and stop them from shopping, right? And close the loan.
I think that's the big one, right? So, actually, I'm going to share this, some stats in just a minute here that'll make some sense. But that's number one. So making sure that the credit is visible and actionable, right? So there's a plan attached to that from the very start. Second is, look to qualify more and optimize loan programs, right? So going back to those numbers, think about your lending strategy. Think about the opportunities that are there. How can you look at qualifying more into these buckets as a way to potentially grow in a down market? Being able to, take share away from other lenders. If you're giving them the best rates, terms, if you're establishing that trust with them, you deserve to earn that business. So I think that's one, is just making sure that you're focused on qualifying more and optimizing applicants into the right loan programs. And then I think the last one here, and this is where we've got some stats around some research that we did last year with recent refi and purchase applicants. And this was actually kind of surprising to me, right? That 60%, this was less surprising. The other one was more surprising, but 60% of potential applicants say that interest rate matters most, right? That's the measuring stick with which they measure or they evaluate lenders. But here's the other thing. I think this is a bit of a wake-up call. I think a lot of lenders probably already know this intuitively, but we know that 50% of consumers would apply with as many as 3 lenders, right? To me, that's a bit shocking because I personally would not go all the way through the application process with 3 lenders, but they're doing it and they're shopping around. And so I think if you connect the dots here, right, what are they most interested in? How are they going to evaluate you? And knowledge that they're shopping around, how can you kind of take that shopping off the table early on, kind of going back to the prior point, demonstrating to that applicant that you're doing everything that you can to get them that best rate, to get them into the best loan program possible. And as we mentioned, there's a lot of opportunity here, right? 6.25 million could qualify that. And these are some verbatims from the research that we did from some lenders, and lenders understand this, right? They understand that if they're not competitive, they're going to get shopped. They understand that coming up front is going with, more transparency is going to increase, trustworthiness. And, just bottom line here, it's a zero-sum game. Most people do not take out 2 mortgages. If they're not going with you, they're likely going to be going with somebody else. So those were the 3 kind of high-level bullets on how we think lenders can use the data that we're going to be putting out on a monthly basis to really think about how they can be more competitive and maybe even grow in what's looking to be a down market.
Awesome job, guys. I want to kick it over to Andrew right away for questions. But before I do, one question for each of you. If you've thrown a lot of data, a lot of information at the audience today, if there's one thing you hope they take away from it, what will it be? Mike?
So I'm going to go back. I'm a simple guy. I'm going to go back to that 71% number, right? Keeping that in mind, keeping the massive opportunity. This is why we put this index out, because it became clear to me when I looked at the numbers that this was not a niche opportunity. This wasn't something that was only for a small number that needed a little help getting over a hump, that it was across the entire credit spectrum, opportunity for people to better their scores. So I think that would be the one thing that I'd want people to walk away with, is the magnitude of the opportunity that's sitting there before them.
Love it. Dan, quickly, what's your big takeaway?
This is the demand side of applicants, right? These are the people who are coming to you for a loan. This is a rundown of the credit scores of those people who are coming to you, which tells you a lot about your applicants. That makes this incredibly valuable, in addition to what Mike said, and you can help 71% of them. So
absolutely. Gentlemen, thank you both. Andrew, back to you.
Fantastic. Thank you so much, Rick. Always great to hang with you and kind of help us keep us in line here. All right, gentlemen, we're going to hit you up with some questions here. We got 5 minutes left. We're going to get to as many questions as we can. And if we don't get your questions here, I promise someone from the credit expert team will get a hold of you. First question, some investor, as an example, a VA doesn't allow a new pull of credit within 30 days unless you have documented changes that will affect the credit scores. Any kind of comment on this?
Yeah, so we work with CRAs, and when we give an applicant an improvement plan, we're telling them specifically what they need to do in order to reach that target score. We also work with lenders to help collect that documentation. So that's, I think, the beauty of kind of what we do here, in that we have a mechanism to be able to ensure that we have documentation around the changes that have been made, and we're making sure that those boxes have been checked at the end of the day.
Okay, fantastic. All right, next question. Are you guys basing the ability for clients to qualify within a 30-day period on the assumption that they complete all steps in the credit expert report?
Absolutely. So, we play in a precision space, right? So we're not saying, hey, you could get to this range, right? We're telling you what that target score is, and we're telling you specifically what you need to do. And it's a great point and a great question here, because, as many on this call know, there's always an opportunity to upset an apple cart, right? So you make these changes, but then you're like, hey, we went and did some furniture shopping and we put it on the card, and you get to underwriting and it's a different story. So we're giving precise guidance here on what they need to do, and it's important that they follow those steps. And I think it's also important to note that you rely on a tool like what we have here, as opposed to relying on intuition and saying, I've kind of been around this business for a while, and I think, if we drop this card balance by this, we remove this authorized user, what have you, that's going to get us the result. As we mentioned at the top of the hour, Andrew, we've analyzed nearly 1 billion credit records, and so we understand, what changes are going to deliver what kind of impact.
Yeah. Listen, you can go based on, because there are some seasoned professionals out there that are able to predict with some pretty good accuracy, but why rely on actually your best intuition? It's like when you could tell actually the Waze drivers or the Uber drivers that show up, actually they're just starting to do it. They're not using Waze. Waze is all about numbers. Credit expert is like the Waze of the credit optimization business.
I think you're absolutely right, and Andrew, I may use that if you will allow me, but yeah, I mean, I'm not going to go up against the machine, right? We've got these validated algorithms that tell you where you need to go, just like Waze tells you where you need to go. So
fantastic. All right, next question. Do we know that the credit bureaus will indeed affect their scores within the last 30 days? Doesn't it usually take longer than that?
So what we model it on is changes that could be made within a 30-day period of time. We actually have options, and we don't want to get into, I'm happy to follow up offline, but we have options where you can look at extended periods of time. But what we wanted to do here for the index was to show the specific, time-bound 30-day, what's the opportunity there? Because, you're moving very quickly as you're looking to originate a loan, specifically in a purchase market. So yeah, that's the time frame that we chose for this.
Okay, fantastic. We're going to wrap this up with one more question. So I understand the strategies that you're discussing to get a 20% point boost to the client's credit score. But other than that, the client has limited funds for down payment and closing costs. They will often still need the gift of funds. So using these funds to boost credit score again, does that again make delays on offering a house and closing? So I guess it's like, where's this money best used for? Is it better off using it for the down payment as opposed to paying off credit?
So it's a great question, one that I will not have a precise answer to because each situation is different. But again, going back to the timeframes, right? So you can adjust timeframes. You can also adjust on available cash, right? And you can look at various plans. Say, look, if you've only got $1,500, what is that going to get you? And then you can start to make those trade-offs, right? You can start to say, well, would it be better paying down a balance here versus putting more down on the house? I think, Dan, you've got, a perspective on this, is that, you can do really well for yourself as well, in the near term in terms of paying down perhaps expensive debt, but also position yourself, for the future with, a better rate on your mortgage and lowering the cost of borrowing.
That's it. I mean, I think this is where a conversation with a loan officer is super important, because both down payment and paying down credit are investments in yourself, which are great. Talk with your loan officer about how you maximize it, right? And how you come out the best long-term financially.
Listen, to me, the big thing now in this super competitive marketplace is you can't just be a call center order taker. I mean, it's being an expert and using these tools like Credit Expert, so you can optimize and be actually someone who's offering guidance, not just answering the phone. Gentlemen, anything you want to say in closing as we wrap this up? Just about on time.
Yeah, no, I appreciate everybody making the time. Yeah, thank you. And again, we'll be sending out a copy of the guide to everybody that was here. And again, we're going to be releasing it every month. So, if you're signed up, we'll be sending it to you. And any feedback that people have, please hit us up.
Fantastic. All right. Thank you for joining us for another Mortgage Banker webinar. Really super excited to come to you on this great Tuesday. Hopefully it's great wherever you are. And we will see you on the next webinar. Have a great day.
Thanks, everyone.
Thanks, everyone.